Hello all, and many thanks for tuning in to our latest Q&A session today. For those that did not catch the first episode, we'll run through some quick intros and then dive straight into some questions that hopefully we feel our listeners would like to know or should probably know before heading into a sale or making their first acquisition here in the UK. We're very pleased to have with us today Zeeshan Khilji, who's Head of Midlands at ETC Tax, joining me alongside Charlie Watson, who heads up the staff and transactions team here at Connect. Keeping our introduction short and sweet, I myself head up the Originations team at Connect, working across both the sectors that we focus on, which are logistics and freight and recruitment and staffing. Zeeshan, I'm going to pass over to you here to give some insight into ECC and your role.
Thanks, Luke. I'm Zeeshan. I am the Head of Midlands here at ETC Tax. ETC Tax are a specialist tax advisory boutique, and I focus predominantly on the tax aspects of company sales and acquisition. Great.
Thanks for that, Zeeshan. So moving quickly then into the Q&A session, I'm going to start things off by asking Zeeshan, do you want to give us some examples that business owners should probably consider ahead of both, well, either a business disposal or a business acquisition from a tax perspective?
Yeah, sure, Luke. So there are numerous tax implications to consider when deciding to sell or acquire a business. I'll first provide an overview of the treatment of sale proceeds upon an exit. So from a seller's point of view, the sale of a company assets or shares involves a disposal for capital gains tax purposes, which is recognized at the time. So the capital gains tax essentially is recognized at the time when the unconditional contract is entered into, rather than the date of completion. If in scenarios where a fixed part of the consideration is deferred, this must be included in the capital gains tax consideration without any discount for the delay in receipt or the fact that the consideration might not be paid. And the original capital gains tax liability can only be revised if the seller can justify to HMRC that part of the consideration is proved irrecoverable. In scenarios such as earn-out deals, we often look at scenarios where the seller received they receive a fixed sum on completion, with further sums being paid over, say, the next 2 or 3 years, which is calculated on a formula based on the actual results of the business over this period. Here, the seller again, would need to bring in, the entire amount that would be reasonable that they would be receiving over the next 2 to 3 years. But here it's important to consider any potential tax risks arising from the earn-out element, because usually with earn-out type scenarios, the seller usually continues to be employed in the business during the earn-out period in a management role. So here, a number of tax issues should carefully be thought through before the earn-out consideration clauses are agreed. Otherwise, the seller can have some undesirable or unintended tax charges, if the earn-out consideration is linked to the seller, staying with the business, because a proportion of the earn-out can then be treated as employment income. So it's important that, specialist tax advice is sought in such scenarios. Secondly, we can also, it's also quite common to see scenarios where the purchaser may be willing to offer shares or loan notes as an alternative to cash to the seller, and by exchanging shares in the target for shares or loan notes in the purchaser, the shareholder may be able to then defer the capital gains tax until such time as the replacement shares or loan notes are sold. Again, here, as specialist tax advisors, we can assist with helping with implementing the right tax structures, obtaining HMRC clearances to ensure that the right tax treatment is sought and any upfront tax charges are minimized.
Yeah, no, there's some great points there. And just going back to your first one with regards to the deferred and earn-out element, typically the transactions that we're dealing with in the freight and staffing space, we see them a lot. You would certainly, I think we would both agree, it's best to try and get an advisor from a corporate finance perspective and a tax advisor perspective in as early as possible, right?
Absolutely, yes.
Great. And so that does take me on nicely to the next question, I guess, in terms of when actually doing the transaction, agreeing heads of terms and moving on to due diligence. What would you say the biggest stumbling blocks are during a transaction, Zeeshan?
Yeah, so most issues and or tax risks are identified as part of the due diligence process, Luke. So, as part of the due diligence process, when the seller would undertake a review of the buyer's, historic, the tax compliance position and any, potential tax risks that can be identified as part of the due diligence process. Specifically from my practical experience, most of the issues arise in respect of employee share incentives, really. So where employees have been given shares in the company, or share schemes have been implemented where the right elections haven't been put in place historically, which essentially can mean that at an exit event, for example, upon the company being sold, any tax liabilities would they can then become the buyer's issue, essentially, because the tax liabilities would then have to be put through payroll, and that can be that can essentially mean that that can then result in that being a stumbling block in practice. To avoid these sort of situations arising, we do advise sellers, especially in certain larger transactions, and especially in PE type scenarios, to undertake a vendor due diligence exercise, which means that they would essentially issue a tax diligence report, engage advisors to undertake a due diligence exercise. They will then issue the report to the buyer, as part of the deal process, so that the buyer is aware of any, areas of tax risks at the outset, so that there are no surprises that transpire later on.
Sure. Charles, do you want to add any potential stumbling blocks that you see?
Yeah, so we've been involved with a few deals where the vendors have overlooked the taxation and missed out on tax preparation ahead of the process starting and then transaction closing. So what happened in both those instances was the vendors rushing the tax planning during the actual DD process, which ultimately caused pretty big deal fatigue and frustration from the buyer. So just advising it's super important for vendors to spend time preparing that vendor tax report ahead of actually getting to due diligence, because ultimately it's going to improve getting that deal across the line.
Yeah, which is what we're all hoping for both sides. So moving on to the next question, in terms of the types of transactions that we deal with in terms of an asset purchase and a share purchase. Zeeshan, do you want to run through, say, from a buyer's perspective, what the benefits are, and then also from the vendor's perspective as well?
Yeah, sure, Luke. So firstly, from an asset sale point of view, the key advantage for the buyer there is that they are not taking on the historic tax liabilities of the seller. However, from a seller's point of view, the key disadvantage there is that they can be exposed to a double tax charge, because when the assets are sold in the company, that gives rise to a corporation tax charge in the company, and then when those proceeds are taken out, then there is a further tax charge there. So that is a key disadvantage, because in a share sale, generally speaking, the sale of shares would be subject to the lower capital gains tax rate, and especially if business asset disposal relief applies, which we'll move on to. Shortly, that can mean that you're only looking at a 10% capital gains tax charge on up to £1 million of gains in a share sale. So from a seller's perspective, yes, a share sale is generally more advantageous. But obviously, there are commercial aspects to consider here, between both the parties. There are further complications. So when we're looking at an asset sale, there is a lot of negotiation in terms of allocating the right price to the different asset classes, and there are, again, further tax implications to consider in respect of whether there's any what the right amount is to allocate to, for example, the goodwill, because if the goodwill was acquired, say, pre-2002 or post-2002, that can have an impact on how it's treated, really, in the seller's tax computation. And also from a capital allowances point of view, there are certain elections that need to be made to minimize any tax charges arising. Another key difference between the two types of transactions is that in a share sale, the due diligence process is a lot more extensive, simply because the buyer is taking on a lot more in terms of the historic tax liabilities of the seller. So some key differences there to consider, really.
No, appreciate that insight. Certainly go into a lot of detail. Charles, do you want to give some insight into the recruitment space and what types of transactions you're seeing?
Yeah, so typically speaking, due to the nature of staffing, the transactions that we facilitated have been share purchases. So the kind of clients that we're working with are profitable, well-performing businesses. But having said that, we are actually currently working on an asset deal for a distressed agency. Zeeshan, is that slightly more common for asset deals? That normally they are with businesses that are in slightly sort of troubled waters.
Yeah, absolutely. Yeah, we see. Yeah, that's exactly what we've seen as well, Charlie. From in distressed M&A scenarios, absolutely, asset sales are more common than share sales.
Yeah. Okay, guys, moving on to sort of our final question, and Zeeshan, you rightfully alluded to it there with regards to the business asset disposal relief, formerly known as entrepreneurs tax relief. Do you want to give some quick insight into sort of how you qualify for this, and then Charlie, maybe talk about what we've seen within the M&A space over the last sort of year, 18 months?
Yeah, sure. So the first thing to point out there is that business asset disposal relief only applies on share sales. So it doesn't apply when the company sells assets. So it's only relevant really when the shareholder is selling shares in the company. What the relief allows the shareholder is to benefit from a beneficial 10% capital gains tax rate, which applies to the first £1 million of gains per individual, which is a lifetime limit, and any gains in excess of 1 million are then subject to the higher capital gains tax rate of 20%. There are certain conditions that need to be met, Luke, for the shareholder and company to be eligible for a business asset disposal relief, and these conditions have to be satisfied throughout the 24 months, i.e. 2 years before the sale. So the conditions are that the shareholder must hold the shares in a trading company or a holding company of a trading group. So you can't say sell shares in a property investment company and qualify for business asset disposal relief. And secondly, the shareholder has to be a director, office holder, or employee of the company, and the company must be their personal company, which means that they must own at least 5% of the ordinary share capital and at least 5% of the voting rights. And as part of the Finance Act 2022, just under 2 years ago, there were additional conditions that were brought in, which now mean that there is an additional 5% economic interest test, which now also needs to be met. This essentially means that the shareholder, has to have rights over at least 5% of the profits attributable to the company, or at least 5% of proceeds from a sale of the company. And another point also here to mention is that there is no full-time working requirements, so the shareholder can be a part-time worker in the company and still be eligible for business asset disposal relief.
Sure. Charles, do you want to give some insight into sort of the influx that we saw at the start of 2021?
So towards the end of 2020 Q4 and Q1 2021, we did see a real influx of deals being hurried along due to the rumours of the impending changes. But I mean, I think given the allowance was reduced from 10 million personal allowance, lifetime allowance, from 10 million to 1 million, and the subsequent challenges to SME business owners over the last 2 years, I can't see the relief being fully scrapped in the short to medium term. But yeah, it's going to be interesting next couple of budgets, and fingers crossed that relief is kept, because it really does help. Helps SME business owners.
Yeah, it definitely rewards them, and I think it will be harsh given what they've gone through over the last couple of years, and it's certainly driving our economy forward at the moment. But no, guys, that does wrap up this session today. And many thanks to you guys for taking part, and also to our listeners for listening in. If you do have any further questions for Zeeshan, I will attach his LinkedIn profile, email address, and ETC's website below. And also, if you guys want to keep up to date with everything going on with Connect, please follow our LinkedIn company page, and do check out our website at www.connectcf.com. But really, thanks for your time, guys. Thanks a lot.
Cheers.
Thanks.
Take care.